All right, and welcome to the option pit method, understanding option structure in calendars and time spreads. So today we're going to talk about what is a calendar spread. Trades a calendar spread share similarities to how the calendar can tell market sentiment, what makes a good time spread, how to use term structure to your advantage, and choosing the right calendar. What is a calendar? A calendar is the buying of one option against the selling of another option in a different month. All right. A calendar is essentially a volatility swap. One buys premium in a contract that is, in relative terms, cheap to another contract being sold in a different month. All right, that's the key. All right. Or one sells premium in an option that is relatively expensive and then buys in a different month where it seems relatively cheap. So terms can be bought or sold or traded across multiple terms. I've seen calendar butterflies, where you buy one month, sell 2 different months, and buy another month. There are all sorts of ways of constructing calendars. The long calendar. All right. A long calendar sells a near-term contract and then buys a long-term contract. All right. It doesn't matter if it's a week, if it's a month, if it's a year. If it's a long calendar, then you are buying the longer-term option and selling the nearer-term option. All right. The product produces a trade that is hoping the underlying doesn't move much, but, and this is the crazy part, but the perception of movement will increase. All right. This combo is called being short gamma and long vega for those of you that follow the Greeks. All right. So when you own a calendar, you want there to be very little movement, but you want the fear of movement to be increasing. So here is a long SPX calendar, and you can see this is kind of what it looks like. And if you look, you can't, the Greeks, obviously it's SPX, so it doesn't have a huge short gamma, because it's just a one lot. But you can see how all that vega, that it's long. All right. And what you really want is this underlying to sit in this range, but the perception that movement might happen to increase. So basically, traders are willing to risk, traders are willing to trade these a lot. All right, they might be less aggressive if they knew how similar the risk profile was another type of trade. So this is actually interesting. All right, is that as I know a lot of people that are afraid of selling straddles. But I know a lot of people that are not afraid to own calendars. All right, does that make sense? Maybe, maybe not. So this is a short straddle. Now take a look at the short straddle, and then take a look at this calendar. Do they look that different? Certainly within the range here, do they look that different? Risk profile is very similar. So when you are buying calendars, you're essentially selling a straddle. The straddle is just capped at how much you can lose. So a long calendar is really just a short straddle that has a hedge on. All right, whereas a short straddle has limitless risk, a long calendar is limited to the cost of the spread. But that doesn't make it particularly safe. It just means it's safer than a short straddle. But you also collect a lot less premium. All right, and at the money, and the way they are at the money, they can behave extremely similar. All right, straddles and strangles can be very similar. The major difference is the vega, all right? And that's because a calendar is long vega. It will provide a cushion in a sell-off. So if you own a calendar and the market sells off, all right, you'll get some cushion because the implied volatility will work in your favor. However, if the underlying rallies, the calendar has the potential to drastically underperform a short straddle. Understanding how the risks affect part of a time spread is the key to managing the risk of the trade. All right. Now let's talk about a short time spread. Anybody ever traded a short time spread? All right. A short time spread buys the near-term month and sells the long-term month. All right. The trader is buying movement and selling the belief that future movement will persist. All right. The trade is long gamma and short vega in Greek terms, and it's similar to a long straddle. So this is a long straddle. This is the risk profile of a long straddle. This is a risk profile of a short calendar. Seems similar? Yeah, they're very similar. The key difference is that vega. Notice they both want the underlying to move. However, a long calendar does much better on rallies, or excuse me, than a short calendar does much better on rallies than a long straddle. That is flipped the way that's written. All right, a long straddle will crush it on sell-offs. So let me just rewrite this for you guys. All right, a short calendar does much better on rallies than a long straddle. I don't want anybody to be confused. All right. All right. However, a short calendar does much better on rallies than a long straddle. All right. A long straddle crushes it on sell-offs where a short straddle might not, or a short calendar doesn't do as well. So again, it's about understanding the risk characteristics of both. How do they move and interact with each other? 1 second here, folks. I lost my comments section. There we go. All right. So one of the, again, you got to understand term structure. Term structure is how volatility is spaced across different months. All right. And every month in an equity or an ETF or an index, or you name it, has this concept of term structure where every month is a little different, right? The volatility of an earnings month in Apple is going to be different than the volatility of a non-earnings month. All right, don't believe me? I'll show you. All right. Let me pull up Apple here. And yes, I'm aware that you're looking at a blank screen. And you can actually see, take a look at the way the term structure is. Here's March, April, all the weeklies. Here's regular April. And here's May. And they're totally different. And why is that? Earnings. All right, indexes do the same thing. But they have earnings events that are more like non-farm payrolls or some sort of Fed meeting. All right, ETFs can be something in China. It could be a grouping of earnings. It really varies. All right, one can visualize term structure. Yeah, if you are new, we do have great newbie stuff. Shoot me an email, marketoption.com. But this is an intermediate webinar. But this should let you know what you need to know to be successful. All right. So one can visualize term structure by looking at VIX futures. All right. And VIX futures bear a close relationship to the contract months and how different indexes trade against each other, how different months trade. So you can see that I pulled this up today, a little earlier in the day, but not too early. Actually, no, this was on the close. So what you can see is you've got the cash index, which is today. Then you've got the April contract, the May, June, July. And you've got this huge term structure set up that totally changes and moves independently. They're all linked, but they're correlated, but they're not tied. All right. Different contract months don't have to move in unison like how S&P June futures and S&P September futures must move in borderline unison. They all move independently of each other. I mean, that's why August looks out of whack, right? You know, if you're going to look at these months and go, one of these things is not like the other, you would look at November and you'd look at August as outlier months. All right, now, looking at SPX, notice how term structure it will be high in like the very first week. All right, so if I pull up my Apple quote again, so notice Apple in the options expiring tomorrow is higher, and then it switches to this normal curve. All right, and SPX is very similar for SPX here. You know, the SPX option expiring tomorrow is somewhat expensive, but then if you look at the balance of the term structure, volatility kind of dips and then starts increasing again. You know, if you're going to draw a volatility chart, it might kind of look like this. Kind of like a check mark. All right, Mark, can you briefly discuss cash VIX versus front month future? I mean, that is in itself a long discussion, but the front month future, the cash VIX is an index, and the front month future somewhat tracks it, but volatility has this concept of mean reversion. All right, and because there's this whole mean reversion, and the futures are European, there's some expectation that the underlying will revert back to its mean. So under normal circumstances, when VIX is low, the futures will trade at a premium and then slowly converge to the cash index up until expiration, in which they actually do become one. All right? And so someone said, is that the dreaded tail risk? That's not tail risk. It's more expectations of mean reversion. So, the VIX closed about 1480 today, right? Historically, is that high or low? It's somewhat low. Yeah, it's somewhat low. It's not crazy low, but it's somewhat low. And so the expectations are that 6 months from now or a month from now or 2 weeks from now, volatility would be where? If you had to bet, where would you bet? Higher or lower? Are they assuming a normal Gaussian distribution? I believe they assume a log normal distribution. Michael. Mode is 13. I believe that is I believe if you looked at a histogram, Mike, of really kind of the median price where occurrences tend to land is more like 17, not 13. Yeah. Median's around 17 and a half. That's kind of really where I consider VIX to be normal. The mean is a little below 20 now after the last 5 years. It's about 19 and a half. So, the point is that volatility, including term structure, has expectations of mean reversion. There is no, all right, so the question is, what is the typical mean for VXX? There is no mean for VXX. There is a mean for the index that makes VXX, but not VXX itself. So so this is a question Bill had. So VIX cash is 14 and front month is 17. There is an expectation for volatility to mean revert. Yes. Doesn't necessarily mean it'll happen, and most of the time it doesn't. Right? Cash is usually correct, but there is expectations for reversion. Usually what ends up happening is, if the VIX is 14 and the future is 17, usually the VIX will maybe go to 15 or 16, and the future will collapse to 15 or 16 with it, and they'll kind of meet in the middle. All right, now, we offer some great VIX futures, and VIX ETN stuff on our website. What were the VIX futures like yesterday with the terrorism in Brussels? Believe it or not, international terrorism tends not to have a strong effect on volatility and or markets, as you can see. It didn't do anything. You got a much bigger vol move today than you did yesterday, and that's because a dumb Fed governor opened his mouth. Now, when near-term structure, expiring weekly aside, is such that near-term options have lower vols than long-term options, that is a sign of a calm market. All right. When the opposite occurs, that means that overall markets are in turmoil. Well, where are we today? Well, if you look, are we in a normal market or are we in a tumultuous market? Yeah. So when you turn on CNBC or Fox Business or Bloomberg, and they're like, oh, all this market volatility, all this market volatility, all this market volatility. You just look at the term structure of S&P 500 options, and you say to yourself, you know what? All's well. All right, you can see this is a normal market. Term structure is somewhat flat, maybe you could make an argument, but it's normal. All right, so this is when term structure is upsloping, the market is loud. The market is like my son, little Mark. It is extremely loud. All right. And then when term structure is downsloping, then that's my son when he's asleep. I know this is a little off topic, but does term structure apply to contango, backwardation, and CL? The options, yes. So the volatility of CL, yes, but the futures themselves, no. Does that make sense? So you got to understand that we're looking at volatility. We're not looking at the actual price of the futures. We're not talking about contango and backwardation. All right. Is it a function of taking out inefficiencies in the market? I'm not sure what you're asking. Well, at least for the next 5 minutes. Yeah, you'd think, but markets are better predictors than you think. So, moving on. Market is loud. That's when you get this upsloping. All right. And when it's downsloping, that's a good sign that the market is quiet. All right, so now let's talk about how to build a successful calendar. All right, Mark, is vol your best determination of market direction? Vol and the vol of vol, I think, are excellent indicators of direction. You know, the one thing we do know, if you just went to cash when VIX futures go backward, you would add somewhere like 800 points to the S&P 500 since they listed VIX futures. Yeah, Mike, we're talking, like I said, we're talking about the option volatility. So if you look at something like OVX or OIV, that's where I'm going to be, this is really pointing toward, not as much the futures backwardation. All right. So I'm a newbie, so this is a bit over my head. Yeah, if you're a newbie, shoot me an email, marketoptionpit.com, and I'll point you towards some far less sophisticated stuff to explain this. All right, so from here on out, I'm discussing the long calendar only and how to execute it. All right, because most of you will not be shorting calendars. You need margin. All right, so there are two keys to a long calendar. All right, and really all calendars. All right, overall implied volatility, the underlying, and term structure. If you can put those two forces together and produce a high or low price on a calendar, low vol and good term structure produce winning calendars. It is that simple. All right. A calendar, recall, is long vega. So the goal of the trader should be to buy the cheapest implied volatility possible. This is going to cause the overall price of the calendar to be low at the time of the purchase. All right. Look at where the IV is in the cycle of the current trade. All right. So think about the overall market, right? Because a calendar, if the VIX is at 50 or the VIX is at 14, calendars in names like even Coca-Cola will be differently priced, and inexpensive or cheap will be different than when the VIX is at 14. It's just a natural part. All right. And so when IV moves in, IV kind of moves in 4 cycles typically. You want to trade in kind of the lower 20% of the current cycle. All right. So where we are right now, the VIX is around 14. We're at the bottom end of the current cycle. All right. So overall implied volatility is low from where we've been trading. All right. When buying a calendar, the trader should be looking for flat to positive term structure. All right. That means the month you're selling is more expensive than the month you're buying. And implied volatility is low. Not always easy to do. Because unfortunately, when IV is low, often term structure is in a steep contango, except in the near term. So getting a positive term structure against low IV. If all you did was put on calendars when implied volatility, when volatility is really low, and you had positive term structure, you would have an extremely positive expectancy on your long calendars. They would make a world of difference in your trading. All right, when you buy low IV options, they have the most gamma. When you sell higher IV options, they have less gamma. So when you buy volatility as a whole on the low end, all right, you're getting kind of more gamma out of that back month. And when you get that positive term structure, it tends to actually soften your movement risk. All right, so if you can get a positive term structure in low vol, you can really reduce the movement risk. All right, when you buy low IV options, they have the best ability to benefit from an increase in implied volatility. And when you sell high IV options, they are more insulated from an increase in implied volatility. Do I have a calendar screener for calendar trades? Yes. Do I give it to people? No. Will I help you build one if you ask me the right things? Yes. Buying a calendar meaning selling front, buying back for a debit. All right. And in contango, that means selling lower IV than owning, buying higher IV. All right. All right. So what you're looking to do is you want to sell backward. You really want the term structure to be flat or backward, where you're selling it a more expensive vol than you're buying. All right. And you want that volatility to be low. Actual movement is a huge risk in calendars. All right. So this means make sure that the trend of movement, or HV, is lower, not higher. All right, you want the volatility trend to be dropping. We'll look at one here shortly. So look for events that might cause movement in the near term, and look for events that might hold up IV in the long term. One thing I love doing is owning an earnings month. Why do I like owning an earnings month? Because implied volatility tends not to drop on an earnings month. Yeah, it tends to at least be pretty stable. Doesn't go up, it's probably not going down, is the way I would describe it. And that's a good thing. We like that. Yeah, the increasing vol, it means that back month option is not going to decay as much. That's something we like. So you want lower IV than HV, but HV to be sinking. You want sinking movement. Calendars can be placed at any different contract month. You can trade a weekly against a monthly. You can trade a weekly against a weekly. You can trade a monthly against a monthly. You can trade a near term against a long term. The key is to find the low vol and buy that cheap calendar. Then find the 2 months that trade against each other best. And then I'll show you an example here. For a directional calendar, make sure one is setting this up as beyond where I think the underlying might go. All right. In addition, directional calendars kind of stink for bullish trades, except for in the lowest of IV environments. I love them for bear trades. All right. They can also be great for illogical trendy stocks like Fitbit, GoPro, Tesla, all the silly ones that rally for no reason because people love them. So here is my calendar checklist that you all run. CMG, perfect. What IV cycle are we in? So where is the VIX in general? All right. And then where is the volatility of this name in general? All right. Now, where is the implied volatility within that cycle? Are we at kind of the high end of the recent range, or are we at the low end of the recent range? All right. What has the movement been looked like lately? What does term structure look like? All right. And then finally, if your assumptions change, get out of the way. If you build a bunch of assumptions and your assumptions are wrong, stop. You can't do long calendar. And all right, does this mean it's hard to find long calendar trades in VIX? You generally, unless you really know what you're doing in VIX, you shouldn't trade calendars in VIX itself. All right, and that's because VIX has a very unique underlying structure. So let's look at one that I do kind of like. This is one that popped on my radar today. What is CCE? You guys know what CCE is? It's Coca-Cola Enterprises. All right. So the top is a candlestick chart. The red line is the 50-day moving average, and the gray line is the 200-day moving average. All right. The red is implied volatility at 30 days to expiration. So where would you say implied volatility is in this name? It is low. All right, now, where is the movement? There's some decent candles, but it looks pretty rangy, doesn't it? Yeah. Now, what does the term structure look like? Now, there's some earnings in there, but take a look here. This is at the money. May volatility is more than August volatility, but less than November. August has 2 full earnings cycles in it. So what do you think of the term structure? Pretty flat, right? You got a little bit you got a nice separation here for April, but the other 3 are kind of on top of each other. So let's look at 2 trades. So I've got the April-May, and then I've got the May-August. And you can see the theoretical values are kind of dead on. So what is the cost of an April-May calendar? About 75 cents. All right. Now, what is the cost of the May-August? Yeah, 80 or 85 cents. Now, which one do you think to me as a trader appears to be more favorable? If I can do a 1-month calendar and get 75, or a 3-month and pay 85. Actually, no. I think the May-Aug is way better. The May-Aug is way better. It's not even close. Now, you got a little earnings in there, but August actually has 2 earnings too. So as I look at these 2, earnings always mess around with things. As I look at these 2, I say to myself, boy, do I want to own, I think that this calendar is inexpensive when it comes down to it. The one right here. Sorry, not a very good circle. Why does the AUG have 2 earnings cycles? Okay, let's think about that. Coca-Cola Enterprises has earnings on, let's say, May 1st. All right. If they report quarterly, when is their next earnings? Right. So in this, I get to own the August that has 2 earnings cycles. Yeah, and I get to sell the one that has 1 and get a nice vol credit because of that term structure, right? I'm selling a more expensive vol than I'm buying. And vol is really low. That's everything I could ask for. So this is what my trade looks like. Tons of room. Good theta, not a lot of gamma, long some vega, a little bit of delta, but not too much. It's kind of exactly what I want in a trade typically. So in summary, understand how calendars are like straddles, and then I'll look at a calendar or 2 after I'm done with my offer here. Understand how calendars are like straddles. Understand the risks and warning signs of term structure. Learn to recognize the checklist for a good calendar and look for the best structure. Now, April 2nd from 9:30 a.m. Eastern Time to 1:30 p.m. Eastern Time. Trading and mastering diagonals and calendar spreads. It's a 4-hour class. All right. And it's a week from Saturday. We're going to teach you how to master long and short calendars. I'm going to teach you risk control and adjustments. I'm going to teach you about diagonals. I'm going to teach you to do weeklies and income trades. And you're going to learn how to do short and long-term diagonals. You go to optionpit.com/calendar. We list it where you list it at $295. It's right now $167. But if you use code 25_off, that will take $25 extra off between now and Saturday. All right? And you go to optionpit.com/calendar to get yourself registered. All right? And it's going to be a great, great class. We already have a bunch of stuff planned. So if you found what we were talking about today fascinating, we're going to really dig in on Saturday the 2nd. All right, any questions? What do you think about double calendars? They're okay. I don't love them. I think there are better ways to trade, but there are times where it can make sense. Can you opine on a April 1, April 15th SPX 1960 put? Well, if you think, here's what I would say about that spread. If you think the S&P is going to 1960, that'll probably work out really well. If it doesn't happen, you're done. It's a decent portfolio hedge, though. I like that as a portfolio hedge. Will the class be recorded? Yes, and you can watch it over and over again. Do you need live vol to trade calendars? No, but it does help. And you can get live vol for free if you use them for execution. Do you find that calendars work better on index, ETF trades, or specific stocks? I like them more for stocks than I do indexes. I'll be honest. ETFs, I've definitely used them in ETFs. So I've got a decent-sized calendar in EWZ because I'm playing Dilma Rousseff having real problems by June and selling near-term stuff in front of it. So I like calendars when I've got a specific thing I'm trying to trade. No. No, it does not. Shoot me an email, mark@optionpit.com, and I can introduce you to the people that'll hook you up. Is there a percent of profit when you decide to close them? Yeah. I mean, I'm typically looking to make about 15 to 20% on my margin. Who do we have to contact, get sent newbie info? You can email me, mark@optionpit.com, and we'll get you set up. How long will the Saturday recording? Forever. At least as long as Option Pit is in business, you'll have access to it. So I remiss to say forever, but I think you get the point. Do gold members get this free? Yes, they do. If you are a gold member or you are a Option Pit Live subscriber, this is free. What is contango? Contango is when a front month option trades at a lower volatility than a long-term option, or when a front month future trades at a lower volatility than a long-term future. Do you have a scan for ideal calendars to do the strategy? I do. I actually run, we're actually coming out with some scans for LiveVol run by us that are going to, and this will be one of the things it produces is a calendar scan. How much time will we spend on diagonals? My favorite. We're going to spend about 2 hours on them. Me and Andrew, correct. All right. Any other questions? Are these the best strategies for today's market? That's so open-ended that it really depends on what you're trading. Today's market is so broad. All right, guys. Everybody have a great night.